What's up, everybody? Welcome to Heresy Financial. A little bit of a different setting today. I'm on vacation with my family. We've been traveling. We'll be traveling this week, so might be filming from a couple of different locations, and we'll hear some cars going by. So apologize in advance for the audio there, but just enjoying the weather, getting out of the getting away from the city for the little bit of craziness that's been going on recently. So wanted to touch base with you guys. It's been about 6 months since I made some predictions for how this year would go in terms of the economy and the markets financially. And so since we're about 6 months into the year, wanted to revisit those 2020 predictions, see how they had panned out so far, see if anything that I was right on, anything I was wrong on, anything that we might be still waiting on here. So want to kind of go through those one by one with you. So let's dive in. The first prediction that I made, and again, this was in December when I made this video about the entire year of 2020, and we're about 6 months in here, so we're revisiting this. The first prediction that I made was about volatility. Now, 2019 was one of the least volatile years that we've had for a very long time. And so based on that fact alone, my first prediction, which I thought was a pretty safe prediction, was that we were going to experience a lot of heightened volatility this year. And unless you've been hiding under a rock, you're probably aware this has been the most volatile year in history, recorded history in the stock market. We've sustained one of the measures of volatility in the stock market is the VIX, that the volatility index. It is calculated by measuring the cost of at-the-money calls and puts on the market. And so looking at the VIX, that's usually the measure that people normally use to gauge volatility in the market. We've sustained the highest levels of volatility in the market for the longest period of time since we've been collecting this data. So yes, I know that we've had a pandemic, coronavirus, some very unprecedented things happening. But when I made this video, it was before there was any talk of market volatility. There was no talk of pandemic. There was no talk of market collapse, anything like that. And so it just goes to show that sometimes, a lot of times actually, technicals and fundamentals usually line up, and it's just the nature of how things work. And so based on the fact that when you have a really long period of low volatility, that's going to be followed by a period of heightened volatility. And so honestly, a lot of the volatility that we did experience, and the speed, the quickness of the drop and the bounce back, and the most, there was 3, 4, 5, 6% days, even 11% moves in the market on single days. A lot of that was kind of pent up buying and selling pressure. Imagine coiling a spring. When you compress a spring for long and then you release it, you're going to unleash a lot of energy. So yeah, the coronavirus was the catalyst. It was kind of the pin popping the bubble, making a lot of these things kind of rush out. But I was kind of predicting these things before there was any talk anywhere of the coronavirus or any news or data or anything like that had come out about the coronavirus. So volatility, that's pretty much spot on right there. And I feel like that was probably one of the safest predictions that I made for this year, but most volatile year on record. So got one right there. The next thing that I brought up in that prediction video was that in the midst of the volatility, whether there was a big market crash or something like that during the candidacy, during the race before the election happens in November, I said that we would probably see Trump start to, he's always shifted blame, obviously, for everything, but he would blame whoever the Democratic nominee was for the market volatility. I said he would continue to blame China because of the trade deal and things like that. I said that he would continue to blame the Fed because he's always been blaming the Fed for not acting quick enough, lowering rates fast enough or low enough. And it was just until recently that he continued to blame the Fed until they finally got to zero. And he said, he finally kind of gave his stamp of approval on Powell for finally getting to zero. Now he wants to go negative. So he's always going to have, something to blame for that, for whatever's going on in the market. And, Just happened to be that the coronavirus came out of China, so obviously he's laying a lot of blame on China right now. Before it was a trade deal, but this is kind of a part of a larger scheme of events where when you have a reigning superpower and a rising superpower, that dynamic has happened dozens of times throughout history, and any little things become large pieces of tension. And so whenever you have a dynamic like this, something like the coronavirus, something like the trade deals, something like manufacturing or anything, they're going to start blaming each other. Now, he hasn't yet started blaming the Democratic nominee, just because, I think at this point it would be kind of, he's got a lot of other things to lay blame on right now that are a little bit more believable. If it was somebody like Bernie Sanders that was the front runner right now, that would be a little bit more plausible for him to lay blame on for market volatility, and so because of the coronavirus and other things like that, he's got some bigger fish to point fingers at this point. Now, the next thing that I said we were going to experience, which we've seen record amounts of already, is monetary inflation, monetary expansion, and we've seen the fastest and deepest acceleration of monetary expansion globally. The Federal Reserve has added $3 trillion, over $3 trillion to its balance sheet since September, October last year. And so we've seen an unprecedented amount and speed of monetary expansion. And again, a lot of that has been in response, at least outspoken response, to the coronavirus. But the coronavirus has allowed them an opportunity to lay blame for some of that, because if you remember, a lot of these things were cropping. That's why I was making these predictions before the coronavirus happened. A lot of fissures and tensions and fault lines in the financial system were cropping up before all this happened this year. And so they are using it as an excuse to do some things that they felt they wanted or needed to do, but didn't have the reasoning to say, hey, this is why we're going to do this. So a lot of the repo market interventions, the quantitative easing, when they were originally saying, oh, it's not QE because we're going short dated, we're not going long dated. Now it's, QE unlimited, infinity, we'll do as much as we want. We have an unlimited printer. So some of the things they felt like they needed or wanted to do beforehand, now they have the excuse to do it. So it's not because of the coronavirus. The coronavirus just gave them the opportunity for all the monetary expansion they needed to do to what they basically bail out the financial markets, banks, hedge funds, etc. Now, one thing that we're waiting on still is price inflation, and that's because whenever you have like a crash or a big crisis or something like this, you're going to have a time where things kind of seize up a little bit. But as of right now, we're already starting to see isolated incidences of price inflation. So, for instance, especially like meat or most groceries actually. And that doesn't show up in the CPI because oil and gas got cheaper, but nobody's going anywhere. So yes, gas got cheaper, but you're not buying gas right now. So the things that you're actually buying right now, the food, is getting more expensive. And you're starting to see a lot of those things trickle out, and it starts in small isolated places, but then in general, as it kind of goes along, just from the supply and demand issues, and then compounding that with the monetary expansion, you start to see the price inflation really take off on a wide scale. And so that's not something that we've started to see in extreme numbers and percentages yet, but it's starting to unfold here. So still kind of waiting on that one to unfold across the system. One of my other predictions was the gold rally, and obviously it's been a fantastic time for gold since over the last 6 months. We did have that period of time when initially everything started getting sold off. In liquidity events, you don't sell what you want to; you sell what you have, what you can, and so gold got sold just like everything else did, right when everything started tanking, and then pretty soon after that skyrocketed up, and it's not yet at all-time highs compared to the dollar. It's hit all-time highs in pretty much, I think, every other currency now, and we're pretty close now. We got the futures price of gold got up to like 1788 per ounce, so we've gotten pretty close here. Not yet taking it out, but we've definitely made 5, 6, 7, 8 year highs so far on the price of gold. So we've had a really nice gold rally. So got that prediction right. And then another thing that we're kind of waiting on, I predicted that there'd be a big stock market crash in Q4. So that's, it wasn't really a prediction for the beginning of this year, although we did have one of the steepest market crashes and fastest that we've had ever. That wasn't really the one I was talking about. My prediction was mainly focusing specifically on after the election happens, because, a little bit of a situation where the people who are in power are going to do what they can to keep everything going, but especially Trump pushing for the extra stimulus, the extra spending, all of the extra debt and the deficits in order to stimulate the economy, in order to get reelected. Because one of the main ways that GDP changes and increases is due to the deficit and inflationary spending, and they know this, and so my kind of outlook was that it would kind of change once the election happened, because now he's no longer worried about that. He's kind of just looking at more what are the next 4 years going to look at, post campaign. So we're still waiting a little bit on that. As far as the next one goes, record monetary expansion, kind of touched on that already. We've seen that. One of the things that we're waiting on still is a financial system collapse. That was one of my predictions as well. And that's, again, right now starting to unfold. We're seeing balance sheet levels compared to market caps of major banks all across the world at extremely dangerous levels. HSBC, big bank, sixth largest bank in the world, their total asset values, their total book, their balance sheets, compared to their market cap, their value of their price per share, times all of their shares outstanding. It's like 3.1%, I believe. And so if they have a 3% loss on their balance sheet, that wipes out their entire market capitalization. And they're not alone in that. They're actually one of the more less over leveraged banks. A bank like Deutsche Bank, I think they're at like 1% or 1.6% right now. And so just let that sink in for a second. Like the amount of leverage that they are carrying and the amount of exposure they have to assets that might go up or down. Both, they're both short and long. Their balance sheets are so big that they make up that only 3%, 1 to 3% of their entire balance sheet is the same size as their entire market cap, their size of their shares trading on the market. So really over leveraged at this point, and any shock, can, one way or the other, can introduce unprecedented or unexpected volatility into their balance sheets, and they're all interconnected because they have balance sheets and they have interactions with each other, and they carry each other's assets, and they the swaps and the the repo market and overnight lending. It's all interconnected. So a domino effect is pretty close. If there's just the right touch or the right trigger, the right catalyst, can start tipping things over really quickly here. And then the last thing here that I kind of made a prediction about was more of an overall economic collapse along with a stock market crash. And so we've seen the stock market come back a lot, despite, in fact, the economic numbers worsening. Unemployment numbers and manufacturing and confidence, and just there's a lot of things grinding to a halt right now. Markets coming back a lot, largely due to kind of future expectations of things kind of getting back to normal really quickly here, but also due to the unprecedented amount of new money that's just been just slammed into the system. And so I expect that for the next 6 months, the remainder of this year, we're going to kind of see a little bit more of the same for the next couple of months over this summer and into Q3. Where we're going to see, rallying stock market, rallying asset prices all across the board as economic conditions worsen. And then finally, at one point, there will be a point in time comes, probably, I think, closer towards the election, maybe a little bit after the election, towards the end of this year, when the market kind of realizes the economy's not snapping back. It's not back to normal. Things are still getting worse. You're seeing things crop up, unexpected, bank failures or, things like that will all at once cause asset values to start to crater across the system. So over the next 6 months ish, my kind of outlook is more of the same: markets and assets rallying, economic conditions worsening until that kind of that divergence gets to the peak point where it can't keep on going anymore, and it pulls asset prices down along with it. So looks like I was pretty close. Still waiting on a couple things for my 2020 predictions here, and if you enjoyed this and have any thoughts, comments, questions, let me know in the comment section below. I'll try to get to as many as I can while I've got limited internet access while I'm traveling around. So really appreciate you guys, and hope you guys are having a good week, and thanks for watching. Have a good day.